It is risk-off time in the markets, and that sentiment is not going anywhere anytime soon. Short-term bullishness on speculative plays have not been able to maintain, and dip buyers are feeling the frustration. Policymakers and political authorities may tell you otherwise, but we are already in a global recession. Stocks are sinking, businesses are letting go of employees, consumers are spending substantially less, and stagflation is very present in multiple economies. Monetary leaders are taking measures and are well aware, but this doesn't mean we will see relief in the short run. In fact, it means quite the opposite.
Make sure to stay up to date with the A1 Edge Finder, our market scanning software. Today only, get a copy of Edge Finder for free by sending a message to our team on Telegram in the description below. Send the code FREEDAY to our team on Telegram below and we'll get you set up for free.
Because of these new policies that prevent borrowing costs from getting out of control, the economy has to enter a contractionary period. Although it is normal for economies to experience times of contraction as well as expansion, economists start to worry if they go on for too long. While the Fed saved the market in 2020, the economy experienced an extended period of growth. The stock market did the same, lapping original price estimates by a long shot. This was a period of unprecedented expansion, and a peak was nowhere in sight. But like all things that rise, they must fall as well. Central banks around the world took a 180-degree turn for the sake of their currency strengths. Policies that bring the value of their coin up will also hurt growth in the short run. These economic shifts take time to affect the economy the way the banks intended, and things get priced in for the meantime. Investors are still trying to value the majors at rates they expect each currency will get to. If conditions are not what they expected down the line, currencies get revalued. Revaluations are not limited to foreign exchange, but also in the equities market. Stocks will take big swings as well. Since early 2022, the indices have fallen well off their highs from declining investor sentiment, and there are a handful of reasons why. Global inflation is taking its toll. Each month continues to ride higher, even as interest rates rise. In a period of stagflation, economies enter a kind of limbo where nothing seems to be improving for the time being. The soft landing expectation raised some eyebrows early on and now seems to be unobtainable now that inflation is as high as it is. Investors expect to see a rocky landing. The only question is how rocky. Additionally, as prices rise, spending falls. Consumers are forced to spend less due to the rapidly increasing rise in goods and services, excluding food and energy. This suggests a lack of economic confidence, so people are not spending it on vacations or leisurely activities. More money in the pillowcase is less in the market, meaning stocks and risk-offs are not of investor interest right now. When it comes to testimonies, it's all in how you say it. Jerome Powell has to be very particular in the way that he makes his statements and answers the ensuing questions. In the latest slew of testimonies, Powell remarked that the central bank has an unconditional commitment to fighting inflation. When investors interpret this statement, they think the Fed will have little regard to the economy while they focus their efforts towards a higher dollar. Powell even went on to say that it is even trickier to fight high CPI without bringing the labor market down as well. The Fed chairman continues to drive home his policy towards a 50 to 75 basis point hike for future meetings. Other countries are doing the same at various rates. This puts markets at risk of a recession. Overall, the soft landing strategy they hoped for will probably not happen once things are said and done. So, the market may be rocky on the way to a recovering dollar, and the concern that a recession could happen is still present, but not definite, according to Powell. Should indices crash through, analysts could see another big leg down. US equities have already fallen further than their 20% drop expectation. However, a bottom has yet to be found. Here's where they might be. A triple bottom level around another 5% lower looks like the index's first target price for a turnaround. The second level is a double bottom around 7% lower, should the market continue to flop. Recent rate hikes and retail slowdown has sunk shares today, as well as sentiment, so a continuation to the downside seems likely. Japan's stock market index is currently 14% off the highs from earlier this year as price falls today with the rest of the global equities. A potential bottom on this one-day time frame looks like $24,482, where there is a previous bottom. Price could definitely sink lower. However, there are not many clean levels of support that would suggest any evident sign for a reversion. German 30 looks promising at the 61.8% Fibonacci retracement zone. More specifically, a previous resistance and support level at $11,311 suggests that price will move here, which is deep into the correction territory from 2020. 3 levels give us an idea where price might bottom out, but one of them has already been broken. The levels are $3,668, $3,587, and $3,392 respectively. The first 2 levels are basic, long-term levels of support, but the last target is key since it is the highs of the 2020 pre-pandemic. The NASDAQ took the biggest loss overall after a 30% drop-off from the highs. It looks like the price will keep falling to a previous bottom around $10,699. If that level gets broken, the index could move to the highs of 2020 along with the SPX500, which would be at 9,748, another 12.5% lower than current price.
Interested in seeing our trades live as they happen? By joining the A1 Trading Discord, you'll get a notification every time one of our traders enters a position. Each trade we share comes with an entry price, a stop loss, and most importantly, a full breakdown of why the trade was taken. Learn alongside our experienced traders, join our active chat room, and ask your questions in our coaching webinars. Between our team of active traders, we trade forex pairs, commodities like gold and oil, crypto, and stocks. By joining the group, you'll be able to keep up with all of it. Sign up today using the link in the description, and don't forget to use our promo code listed below for a special subscriber discount. Thanks for watching, and see you inside.